Hi guys, welcome to Compound and Everything. My name is Chris and this is the channel that is dedicated to discussing all things investing, finance and business. Hopefully helping you build and grow a long-term successful portfolio. This video is completely dedicated to discussing 4 stocks that I have on my personal watch list that I think that you guys might be interested in adding to yours. Now, of course, if you haven't already, feel free to click that subscribe button and the little notification bell next to it so you can stay up to date on all of my latest videos. Anyway, let's get this video started. I think most value investors have had a pretty rough time over the last few years. For the most part, the market just seemed a little bit too expensive. However, in the last couple of months, there's no doubt as value investors, we have had a few more options on the table as compared to say 6 months ago. Now, the goal with every long-term investment you make is to find that margin of safety through hopefully buying at a discount to what you believe the future value of that company could or would be. In saying that, some of these companies are or will be directly impacted by the pandemic and its macroeconomic ripple effect still to come, which very well could change their fundamental position over the next 6 to 12 months. So in saying that, let's get started with our list. I'm going to kick things off with one from the left field, which is Australia's largest collections agency, Credit Corp Group. Their ticker code is CCP. Credit Corp up until February was one of the largest 50 companies listed on the ASX. For those of you that may not have heard of them before, these guys are a thoroughbred long-term performer, producing a consistently growing revenue stream for well over a decade, a fantastic return on equity, reasonably well managed debt, all surrounded by a very solid management team with a proven track record. However, as you can imagine, in times of hardship or recession, collections agencies really do get smashed. In the GFC, Credit Corp's share price went from $12 to just over 50 cents in a matter of 12 months. However, before I carry on with that, it's worth noting that those courageous enough to buy the security in 2009 and hold it for the last 11 years would have achieved a return of 1,700% plus dividend income, which is a pretty decent return over an 11-year period. Now, to be expected really, this time around when uncertainty struck the market a couple of months ago, Credit Corp's share price went from all-time highs of $36 to near $6 in just a couple of weeks. Of course, like most listed companies, they have recovered slightly since March, currently sitting at around $15 per share. But as you can imagine, if the share market were to decline again, I'd have it a guess that Credit Corp's share price probably would be right there leading the path down. And I guess the main reason for that would be that in hard times, bad debt is probably the very last thing to be paid back. So you're probably thinking, why would I ever consider putting a company like that on my watch list? Do I just want to lose money? Well, before I answer that, I need you to do something for me. Just go ahead and tap that like button down there. It really does help me in taming the beast that is the YouTube algorithm and of course, continuing to grow this channel. Anyway, we can now return to the regular schedule of this video. Like I was saying, am I crazy and do I want to lose money? Of course not. For me personally, the answer comes back to a couple of points that help shift the probability of profit or success in this position in my favor. First of all, and most importantly, around Australia, New Zealand, and a couple of other countries in the world, these guys are the best in their field. Not to mention, they've come back from a recession before. That means they aren't kind of sitting around a table drawing up a game plan from scratch. They already kind of have it. Not to mention, they have an incredible moat, which you would think in this industry is nearly impossible to obtain. Still, nobody has come close to touching them in many, many years. Now, my second point is that they are in a position to manage their debt quite well. They have a decent amount of cash on the sidelines at the moment. Now, of course, that amount isn't endless by any means. However, one of the benefits of running a very profitable company that grows its earnings per share and revenue year on year is that you're generally speaking going to be in a better position when reaching these types of situations. And the third and final point for Credit Corp is that when all of this is over, their service and their model will still be very much essential. Although they are hit hardest in recessions, they also make the most profit coming out of them. Why? Because these guys purchase debt from some of the biggest players in Australia. And debt is a profitable game long term if run by an organization that knows what they're doing. Now, like I said above, I don't currently own shares in this company right now. However, they are very firmly placed in my watch list, and I'll be continuing to monitor their situation over the coming months in hope for a suitable entry position. If you guys are interested in kind of a full analysis or breakdown of Credit Corp Group, let me know in the comments below, and if enough of you are interested, I might end up putting together a dedicated video for them. So moving on, that brings us to number 2 and 3, which are both REITs in the commercial space. They both hold very minimal exposure short term to the current pandemic. The first is National Storage and the second is Viva Energy Reit. Now, National Storage REIT owns approximately 125 storage centres covering Australia and New Zealand. Within those centres, National Storage manages roughly 50,000 clients over 77,000 individual storage units. Now, moving on to the Viva Energy REIT portfolio, it includes 454 freehold service stations located over all states and territories within Australia. All of these properties are leased to Viva Energy, which is also listed on the ASX. So it's important to remember here that Viva Energy actually have a REIT and the company themselves are both listed on the ASX. Let's kick things off with National Storage and their basic fundamentals. To start with, they've been providing a very high return on equity over the past 4 or 5 years. Their earnings per share and revenue growth has also performed year on year over that same period. Currently, they are trading with a very reasonable amount of debt and under net tangible asset value. So at this point, the fundamentals are definitely there for National Storage. So then I guess that brings us to looking at the product itself, which obviously has almost no exposure to the current pandemic in my eyes, as any potential clients that would have defaulted on their payments throughout this period are most likely very quickly replaced with new clients coming into the facility. Now, well-run storage facilities like these are generally speaking outstanding performers over the long run. In fact, prior to the pandemic, there was talk of a takeover bid coming out of the US for $1.9 billion, which is a significant increase on the current market cap of $1.1 billion. However, since that time, the bid seems to have fallen through, which I guess is really to be expected in times like these. I definitely do wish I took a stake in the company when the share price hit lows of $1.20 in March. However, I guess that was not meant to be. And I will definitely be watching this company very closely over the next few months to try and gain a position myself. This brings me to Viva Energy Reit. This fund is very simple and in my opinion probably one of the greatest hidden gems on the ASX. In saying that, if you're looking for rapid capital gains, this REIT is probably not your cup of tea. However, if you are looking for decent income that is somewhat protected from COVID-19, this might be a great one to bring up with your planner. At the time of filming this video, it is currently sitting roughly 20% down from its 2019 share price. However, this fund is producing a 5.5% dividend. A dividend that in fact has been growing year on year now for a little while. Like I mentioned above, the sole purpose of this fund is to own service station freeholds and lease them to Viva Energy. So as long as the lease is paid, this fund is ultimately happy. As one of the great dividend performers in Australia right now, it definitely might be worth putting some research into this one and discussing it with your plan. Now, this last one might ruffle some feathers and is not my usual long-term holding. At least in my opinion, this is considered to be a speculative play, not something that I would be owning for 10 or 20 years. But just hear me out on it and I'll try and explain why it has found a way onto my watch list. Now, of course, I'm talking about Flight Centre. I'm not going to get too caught up in the fundamentals of this one here, but I will address them briefly nonetheless. Before the pandemic, this company was another true thoroughbred performer. I mean, listen to these figures. A 5-year average of 18.5% return on equity, year-on-year revenue growth for the last 7 years straight, 1.3 billion available to them in short-term cash and loans, and a positive earnings per share for over the last decade. Now, of course, 2020 had other plans for them, and by no means am I buying them at this stage. However, if the right price does become available, that could take into account near 70 to 90% declines in revenue for 12 to 18 months, along with potential losses of their fixed asset base being taken into account, then it may become attractive to me as a short-term speculative play. Now, yes, that does go against everything I would normally suggest. I mean, after all, Buffett does say don't buy a stock unless you're willing to hold it forever. But Mr. Buffett forgot to mention that he actually had a taste for the odd speculative play himself as a younger chap. Currently, I do allocate 5% of my portfolio to somewhat speculative plays that I believe have a medium to high probability chance of turning into a profitable position. However, at this stage, that part of my portfolio is 100% cash. So I'm definitely in the market and looking for a new opportunity in that space. But for me, Flight Centre just isn't there right now. If any of you guys are interested in a more in-depth review on Flight Centre, please just comment below. I'm currently considering a dedicated analysis of them and possibly Webjet. So just let me know below in the comments and I'll see what I can do. In summary, I think that most of us probably expected your average run-of-the-mill recession or correction to occur for a while now. However, I don't think any of us saw it coming in the form of a pandemic hitting on multiple fronts like this is at this point in time. And look, it's all fine me giving you a list of 4 stocks that I have on my watch list right now that I believe that maybe you should consider putting on yours as well. However, the best thing to do in times like this is probably start buckling down on your own fundamental position financially. Get that emergency fund together and make sure your personal finances are in line before investing your hard-earned money. Now, of course, like always, this is not advice. You should always speak with a professional before making investment decisions. I hope you enjoyed my kind of mini analysis on those stocks on my watch list. If you have enjoyed the content and haven't already, feel free to press that subscribe button and the little notification bell next to it. Also, feel free to pound that like button. It really does help out the channel. Once again, guys, I appreciate you watching this video. Thanks again, and I'll see you in the next episode. Cheers.